Hey everybody, welcome back to Generating Income in Your Portfolio. My name is Mike Fairborn. Great to have you here today. Folks, today I did want to still continue our discussion that we've had on some of the covered calls and maybe three key ways that traders will look, amongst others, and investors will look to put on a covered call, how it can help them in certain conditions that they're anticipating seeing within a given stock. So I'll look forward to going through that with you. Would like to welcome all of you here today. In our discussion, BJ, we've got BJ Longsnapper. We have Sim the Architect, who I think is coming to us from Europe, if I'm not mistaken, Sim. Correct me if I'm wrong. But hello to you, Mike Morrow. Got Life in the Fast Lane and others. Welcome all, folks. Yeah, any questions, comments you had, throw those in the chat. My very good friend, James Boyd, you'll see me in the chat as JB, can help assist me with any questions that I miss here or, that might just be specific. So with that, let's go ahead and dive on in to our disclosures here to get started. So first off, I wanted to note that options do carry a high level of risk. They're not suitable for all investors. Information here is for general information purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Covered calls provide downside protection only to the extent of the premium received and limit upside potential to the strike price plus premium received. The paper money software application is for educational purposes only. Investing does involve risk, including the loss of principal. Past performance of any security strategies not guarantee future results or success. A couple of different additional points listed here. Just a couple to note, there are risks associated with investing in dividend-paying stocks. Of course, within this class, we're always focused in on dividend stocks. Today, we're just adding a little bit of an additional wrinkle like we kind of did last week in terms of generating a little bit of additional potential income. And so wanted to state that those dividend-paying stocks, including investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends altogether. So those are the risks associated with investing in dividend-paying stocks. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An ITM option does have a higher risk of being assigned early. So with that, let's go ahead and take a look at our charts. We'll go full screen here. In fact, I'm just going to start off with the S&P 500 index before we can kind of talk about some of the other areas. Now, this is a long-term chart. You can see the SPX in there. I've got a longer term sort of a trend line sort of drawn through the middle. As you can kind of see in here, there is a technical indicator that can help us with this. This is kind of referred to as the mean line, and sometimes prices will revert back to the mean of the trend. You can get that, by the way, anytime you're trying to find that midline. I actually guessed it right on this one when I did it. It looked like the middle line. But if you're adding an indicator, you can go to linear regression, and it's just linear REG. I go with the 100, and you'll see over here what that does. And there is a red line in the middle here. Now, the reason why I put this up here is because it does tend to give, in terms of the variation, statistical sort of probabilities in terms of potential for prices to generally go within a range over a given time frame that we're looking at. You've got an upper band, you've got a lower band, and you've got what's referred to as sort of the mean or the middle level, which prices oftentimes will revert to. You can see there has been a lot of activity. As a matter of fact, even more recently, when prices get above the mean, look where they go down to, here, and we're right in the middle of between these two lines. But who knows, maybe this could act as additional level of support. Why I bring this up now, okay, is because there are some considerations where traders might try to consider, whether they might consider selling the call for the covered call. Where might they sell it at? Well, one of the ways they could look at this is, here our prices, it's according to linear regression, and just like a standard sort of deviation, they're looking at maybe prices not extending up to this high. So I know we're just looking at the S&P 500 index, but as an example, this could be an area where traders might look on any given stock to maybe sell calls if they were expecting to just stick with that stock. If we're looking at an index here, I'll pull up a stock here in just a second, one we're actually going to look at today, but that could be an area where somebody could say, well, you know what, this is where the probabilities in terms of standard deviation are up top. We probably, and that's the key word, more the odds of it, or whatever the people might want to say, just the chances of it getting above that level just might not be as high, right? And so they might sell that if they want to anticipate staying into a stock. So that can give sort of a correlation to where prices might be headed. It could help us to give us a general sense of that. It can also help us on the downside too. We've talked about in this class, and I teach, short covered calls and short puts on Monday, kind of a lower range to look at. It's really quite a lower range, but when prices are above the midline here, or the mean, that's an area also where traders could look for potentially selling options as well, maybe more along the put side, for example. I'm going to dive into the covered calls here in just a second, but wanted to throw that out there to you. It is kind of an interesting observation and a tool that is used specifically by traders to give them a general idea. Hey, what is too high and what is not? Let's say, for example, let's go over here and take a look at T-Mobile, TMUS symbol. Where are we at right now on T-Mobile? We are at the upper range of that standard deviation, right? In terms of our linear regression line, we're at towards the upper range. And so oftentimes when you get up here, there might be some consolidation. We actually do have shares in T-Mobile that we could take a look at here. But as we're right up to that point, we're very close to 250. And there is a 250 call that we could look at in case we wanted to say, well, I'm okay giving shares up at 250 if they were to get called away, or if they were going to be maybe a little bit more neutral, perhaps you could say revert back to the general mean line over here. But it gives us a sense that maybe we're a little bit overdone on shares that we own, of stock that we might have too. So this can be sort of a helpful technique. I wanted to throw it out there initially because I did want to tap into it a little bit today as we go through this. Let's do this. Let's go ahead and take a look too at sectors, because when we are looking at the I should say recovered calls, here's a sector grid. There it is right there. There's our sector grid, big picture. And you can see within these sector grids, oh, okay. I didn't know this would come up. It's kind of like this light blue turquoise line. I have not seen this yet on a black backdrop. But having said that, this can also be helpful if anytime we were looking to maybe sell a call option in terms of, well, what a lot of traders will look for is, investors, is the buy right, where they immediately buy the underlying stock and then sell the call right after, right? Very close to the same time, generally speaking. Looking over here, what sorts of sectors may have been going into a sideways channel, because when we sell a call, in a lot of cases, what traders are looking to do is just make sure, they want to find ways to generate additional income on top of the dividend as prices are going sideways and not extending higher. Because really, in terms of the capital gain side, there's really only one way to make gains on stock, and that is buying low and selling high. But if prices do go sideways, that would be up a little bit, down a little bit, or sideways. Well, we can collect income from that covered call. And of course, you could always, as long as the company is a dividend payer, continues to pay that dividend, you could also potentially collect dividend income as well. So looking at the sectors can be helpful. You'll notice over here in energy, it has been going a little bit sideways. There has been a little bit of upward movement too. When you have the sector grid, it can be an interesting place to, look for companies that may have been going sideways or potentially heading up as well. Either of those two could work for, let's say, a buy right covered call, for example. Now, if I go over here into my monitor tab, you can see that we do have a list of some stocks that are in here. Let's get that pointer going. There we go. Within our generating income, and these are the positions that we're currently holding right now. As you can see, we've got, this is a energy company. I want to look at that and Johnson & Johnson today. Remember, this one got a little bit messed up because of the stock split. It's only up, I want to say, about, I've got to adjust this, about 3,000. I think it's our biggest one, 3,600, something like that. We've ridden that trend for quite some time. But let's look at ExxonMobil. Happens to be in the energy field, right? In the energy area. What do you see? Is it similar to what the sector was showing us? Folks, the sector was, in fact, flat for a period of time. We're kind of flat here as well. We do have this in our portfolio. we've talked about this stock previously, but it may do what it has been doing for the past, this is actually a 2-year chart. So the last 2 years, right? It may continue to trade sideways in here. It does have a dividend, and you can see I do have the dividend yield link up top here for us to kind of take a look at right there. About 3.36 at this level. So it's actually okay relative to a lot of other companies in the energy area. In terms of a dividend yield, one source of potential future income, as long as they keep paying that dividend out. But then also selling a call on our shares too. We actually have 100 shares of stock. Now, quick note, you have to have at least 100 shares of stock to sell a call against it to create a covered call where you're actually covered, right? So 100 shares of stock and it's minus one call of a standard equity options contract, right? Got that one call in there. So a quick note, if you don't do that, if you ever to sell 2 calls, that ain't good. I mean, because then we're naked 1 call. And what is the risk to the upside if you're short a call? Well, it's unlimited risk because prices don't have an upside cap. And so making sure you have the same number of shares, the right number of shares out there can be very, very important to do. So it's an important concept. All right, well, let's look at this right now and just see where we're at. What are you guys thinking? I mean, when you look at a stock like this, you could say, well, we came off this high over here. Yeah, right? And we've kind of held sort of in this range through here. I'm going to throw on our linear regression line again, just to kind of show you where that upper boundary might be. But I'm even getting a sense here that there may in fact be, I'll just put a big R through the middle of that, resistance at those 2 key horizontal levels, meaning that these could be areas where we may consider on this stock to try to generate additional income selling at these strike prices in through here, perhaps, okay? It really does depend on what you want to do with the stock as well. Do we want to hold on to the stock? Or are we okay giving it up? If we wanted to give up this stock, we wanted to try to sell it. We've talked about this concept too, right? I mean, here we are. Let's say, for example, if we had I think, let's just say the 120. If we sold the 120, which we're very close to right here, well, the call premiums are going to be higher here, right? Because we're closer to at the money where the stock is trading at. But remember, if the price of the stock were to go up above this level by expiration, it's very, very likely that we have to give up our shares at 120. Now, that's not a complete loss because you could see up top here, the stock is trading at, let's just say, approximately 118. If we give our stock up at 120, well, we still make $2 on that, right? Plus the option premium, plus the premium short. Okay. On top of that, so is that not also an additional source of potential income? Absolutely. Let's just take a look and see what we've got on that in terms of our linear regression line right now. And oh yeah, it lost it. Okay, that's okay. We'll just type it back in again. Linear regression on the 100 channel. We'll click OK. And there you go. So there's kind of the upper range. It's actually above where we're at right now. You can see the mid-range right through here. And that was you actually have to look at the Y up here on our Y-axis to get a sense, because it did just change to percentages, as you can see. But if you come over here and take a look at that, it's right around 115. We are looking at, maybe prior resistance levels, clearly below the upper linear regression line. It's below that line, but let's say 125 to 120-ish. Let's go ahead and just take this off for now. We could look at it again with these other stocks that we have in mind, but there we go. It doesn't flip back to my Y-axis in numbers, so I've got to go back here and change that back. Take the show percentage prices off. There we go. Okay, so let's look at those numbers right there between the 120 and the 125 as they stand. Now, we can look at, I was going to look at actually the January timeframe here as well, but this is where we stand on this stock. So there's your 125, and there is your 120. We really don't have anything in the middle. So that's kind of the range we're looking at. Now, one thing too is we talk about delta. Delta again measures for every $1 increase in the price of the underlying stock, the delta will increase or decrease. The option will move up or down based upon the amount of the delta. In this case, we're on the call side. It could go up. Now, a lot of times traders will look at a 0.2 to a 0.4. Now, we're slightly above that on the 0.44. We're above the 0.40. So, the 0.2 actually does fit for the way a lot of traders will look at this, because this is an estimate too, in terms of a percentage estimate, in terms of prices getting above that level, that is the 125 by expiration, which is in 52 days. It's that January monthly call. Okay, so if we looked at the 125, does that give us a little bit more range to sell that call at? Yeah, I mean, it's up here. It's up towards the high end where prices were up top. So there we are. We're right up towards the top. In fact, you could actually say that we're crossing right through the body of that candle. That was a little bit of a shooting star pattern, but we're holding below it. So, what can prices do ahead of that January expiration without shares getting called away? Well, there's no guarantee. It's just there's a much higher likelihood that we get called away if we're above the strike price by expiration, if prices do go above there. And it's a much higher probability that we just collect the premium and hold on to our shares if the price of the stock holds within a range over this time frame too. Okay, so there it is. There's our 120. Let's go ahead and put that trade on right there, and let's take a look at it. Or, excuse me, the 125. So that could yield us right now about $125 per contract. We do have 100 shares, and so that's a full covered call right now, just by selling one contract against it. I did click on the bid to do it. That's why we're selling. Let's click on the confirm and send and take a look and see what we've got here under our risk profile. Now, risk profile says that our break even, in other words, if the price of the stock goes sideways, the break even actually now is better than where we would have otherwise been without it, right? That's still, and we read this in the disclosure, there's a small incremental benefit if the price of the stock goes sideways or even dips a little bit, right? The short call can help offset that decline, right? There's a max profit there of 128, so it offsets it by like $1.28 right down here. Real quick on that, yeah. So if you take a look at $1.28 and you subtract that from 117.97, you're going to get that break even. So like I said, a little bit of a buffer to the downside is what it can provide us there. Now, the max loss does say infinite. It's not quite understanding that we have 100 shares of stock already. That's not exactly true because we are covered at the strike price that we're selling. We're covered at 125. Okay. The buying power effect, it recognizes it here. We are not, as you can see right there, the buying power effect at 100 is 0 right there. So it doesn't cost us, there's no additional margin requirement or requirement to sell this call option, which wouldn't be the case if we were just straight out just doing it by itself, referred to as just being naked, that call option. There would be a buying power effect. Now we'll go ahead and send that through right now. Okay, so we've got that in place. Everybody clear on that? We've been going sideways for a while. We actually picked up on this just by looking at the sector itself. The sector, the energy sector, had been flat. So too is ExxonMobil. Look over here. What could we get over this time frame? Well, we're actually past the dividend. But if somebody had been holding this, like we had in this for a little while, we've been holding this stock within our paper portfolio. In fact, we've been holding it, I think, over here somewhere for a little bit and really haven't been doing too much, just making a little bit of progress, a little bit of gains on it. But, see, we went sideways through here. And these are, in fact, months, as you can see. These are months in here, right? Yep, right down below. You can see it. And there are contracts, months, that we could potentially have been selling above this range, right up top here. Call options to do what? To generate potential additional income because the price of the stock was doing not a lot. I mean, we were just kind of swimming sideways here. Just nothing. We weren't really trending higher, right? In fact, much of this, look at this, all the way back 2 years ago. If I draw this line, we are below that level today. That's at 120. Effectively, we haven't done a ton. Now, there may be this huge expectation sometimes I'll look at a company and I say, yeah, I think there could be windfall profits if this and this and this happen correctly and things go really well. But in the meantime, you know, it might go sideways for a while, and this has gone sideways for quite some time. And so it could be a source of additional income selling the covered call on a stock that that you're holding, that you want to hold for a period of time and, extended period of time. All right, one last thing on this, and then I'm going to go jump to a different stock real quick. But the other thing is we mentioned at 120, that initial call example, we saw that we would gain about $2 here on the underlying stock if we were in fact called away. We took less premium and we said, well, here's a 125 strike. We took less premium. What was it, $1.28 or $128, right? We could get on that 100 shares of stock. But what could we also get to add to that 128 if the price of the stock goes up to that 125, and let's just say it exceeds that level or gets very, very close to it? We'll just give an example. It goes right up to 125. You're not going to see black there, are you, on the chart? Okay, let's do this. You're going to see yellow. There we go. If we were to go between, where we're at here and 125, well, you can go ahead and add in $700 additional dollars there, because that's the capital gain improvement on the stock too, right? I think when we look at these, you have to have a really good feel. I'm going to say this before we move into our next stock. You have to have a really good feel as to what you believe you're seeing on the chart and what may happen with the stock going forward. We have 100 shares of J&J still, I think. Yeah, we do. Let's see. PL Open, we've had this for a while, but PL Open is $50. We're down $50 on it. So it has gone sideways clearly. This level right here actually was the same level we've been at in March of 2023. And it appears 2024, we were in that general range, and here we are again. Now, there is this big dividend right there. And by the way, did we get today was the ex-dividend date. By the way, so anytime we wanted to try to capture a dividend, you got to own the stock the day before at least the ex-dividend date, which is that date right there. Okay, 100 shares of stock on it, meaning we can sell grand total of one contract. You don't necessarily have to do it, but are you seeing anything here with J&J that might be an indication of a trend? Thinking a little bit, saying, let's say this is a stock we have in a portfolio. We see the stock going down. Has it yet to bottom yet? We don't know. But we can say pretty clearly that right there is a low. And that's a low, right? That's a low right there. So we got a low, we've got another low, we got a lower high. Is this another lower high? Question mark. We don't know. We won't know until we start to break down below this low. But there may be some support at 150. It's a big round number, and we bounced kind of off that 150 previously. So if somebody said, well, I still think towards the end of the year, healthcare has been going down. By the way, that was one of the companies over, I should say one of the sectors over here. Where are you? Right there. That has really been going down. So the whole sector's been going down. Now, that can also be very, very interesting information, because if the whole sector's going down, it's kind of fundamental in nature, and it can be difficult for it to just flip out all of a sudden. Now, if we were to have seen, the healthcare industry starting to make higher highs and higher lows, the sector itself, right? Then we might have said, maybe we're not really looking for a covered call, because there just might be a lot of upward strength in the future, which could be true. It might have, sometimes the sector will lead some of the laggards in the group, but that's not the case. The sector is making lower lows and lower highs even over a longer time frame than Johnson & Johnson. So I'm just throwing a couple of different ideas out there that might convey to the investor that the price of the stock may continue to go down or sideways. Could that not also work in terms of a covered call? Maybe more of the sideways. I mean, but if it's going down, we did say that there is that one, hit on demand there. We did say there is that one small benefit of the covered call as well. So let's go back to that J&J and we'll pull it up right there. Okay, So in terms of a covered call, where might we look at the covered call? Well, a couple of things. Since we're looking at a downward trend here, there's a low, lower, high, low. That area right through there, that's our last low. Right about, it's not exactly there, but it's close. It's close to that 160. And there is, I'm going to just put a line, resistance there, resistance there. There was support. There may be some additional going back further, but in the shorter term, we're going to have to get above that resistance in order to go higher. So could we look at the 160s, and what do those deltas look like? And by the way, what are we getting in terms of a strike, in terms of a premium there? Okay, for our 100 shares of stock that we already own. Well, there it is, 163 to 176. There's your 160 right there. The delta, if we follow it over, bam, right in the middle. This is outside of our range. The 14 is. If we're looking at the 20 to 40, right? That's outside of the range to the downside. So that's too low based upon what we were talking about. The 50 is too high right there. But the 30 is right in the middle of the 20 to 40. Look at that open interest in the thousands. We have a lot of volume traded today as well. Pretty good spread between there as well. Let's go ahead and take a look at that 163. Let's click on it and let's start selling some more premium here. Let's take a look at it. What does that 163 do? It offsets to a degree, a smaller degree, a potential move to the downside, right? Let me look at this one more time. Yeah. Oh, 163. Okay. There's your break-even prices. Something's not quite right here. We got 163 here, but look at the break-even. The break-even has an issue with it because it says that we're trading right now at 154. We're a long ways away from that. It just caught my attention there, right? Last price on J&J is 154. Huh. Don't know about that. I will say that looks right in terms of the max profit. That would be our max gain. I can say that our buying power effect also is zeroed out, and our max loss is a little bit off because we do own the 100 shares of stock. So, yeah, I don't know what's going on. Let's see. One contract. Yeah. Okay. Well, we'll add it in there, and we'll go from there with it. Okay. Now back to the T-Mobile chart. Taking a look at that. Oh, I don't know what happened there. Let's try that again. T-Mobile has seen some strength. And by the way, that T-Mobile has shown strength above and beyond a couple of its key competitors. You'd have to say Verizon's a competitor there. Just thinking of wireless services. Verizon clearly. Well, okay, it's Verizon hasn't been too bad. It's been kind of stagnating for a little while, but then there's also AT&T. We do actually have 100 shares of stock of that Verizon over, AT&T, no, T-Mobile, our first one. All right, there we go. T-Mobile, there you are, TMUS. There we go. We got 100 shares of stock of that T-Mobile. And that T-Mobile has been really strong. We took a look at it on the linear regression line. We're very, very close to where we are right now. We're kind of touching off that upper range. But if somebody said, okay, cool, maybe it does revert back to a mean. It's been really, really strong from this longer term consolidation here. But in fact, if we were to dip a little bit lower here or go sideways, or if somebody's just simply willing to say, well, because this is another way to potentially get rid of or sell shares if, it's obviously prices have to go above there. But let's just say we get above 250 by expiration. So we get above this level by expiration 250, then we're very just likely to give up our shares of stock, right? At the 250 price. But what do the premiums look like there as well? So let's go ahead and take a look at this. This is a little bit different. Now, we're kind of looking at it through this perspective. We're okay giving up our shares of T-Mobile. We're okay because we think it's already had a big run. So that's kind of another wrinkle I was mentioning to you. Think about it this way. If you've had a stock for a longer period of time, and you want to try to get out of that stock, but then also try to receive a potential premium for doing so, you could sell a covered call. We don't know if we're going to get called away, if price is going to go above there, but if that was your expectation, that still is a way to do it, right? Okay, here's your 250 right there. Now, when I say, you're getting out with a premium, what if the price of the stock went to and it's not going to do this exactly, but let's just say it gets very, very close. But for the sake of our example here, let's say the price of the stock goes up to 250. And we could be looking at any stock as we do this. We're just looking at T-Mobile for now. But T-Mobile climbs up to 250, like we were kind of expecting it to do, and we thought, it's kind of one of those rounder numbers. Maybe somebody tries to sell there, but it holds up to 250 through expiration at that point in time. And then it begins to go down. This is all, projected. It's a projection. We're not there yet. Hasn't happened. But if that is our expectation, could this covered call generate additional income for us? We get called away. Let's say we're above our strike price at 250 by expiration. What are you guys seeing on the chart? Does that seem like it could be a strategy if that was the expectation to happen? What do you think? What else would we make on this? Well, per contract, we could. Or checkout doesn't like a couple of those in there. Okay. Yeah, exactly. Okay, so there we go. Just chuckling at that for checkout. Okay. That right there. And what side are we on? We're on the bid side, folks. Right there. So what could we do? If it goes to 250, we're called away at expiration, generate an additional $515 because we sold it at the 250 strike. Just want to let that sink in because it can be, when you look at a covered call, maybe it's a way to try to close the position and still generate income. Well, because you're already planning on, you're good getting out. Some traders might even do it lower, but maybe they choose a 240, for example, or whatever. They just really want to get out, and they think they want to get a premium to do so because they think prices are going to come down. So these are just some thoughts I wanted to throw out there to you because, you don't always think about that when you're selling calls in terms of a covered call. You might just be wanting to hold the stock for a long period of time too. And that might be obviously the more common approach that's being used. But just wanted to state that there is that little bit, it's not too bad. I mean, $515 if in fact it did unfold the way we're looking. All right, so let's do that one. That's the 250. That's a 43. It's very, very close to the 0.4. There is the 260 if somebody was really much more bullish and thought it would go higher. If they decided to go more bullish, what's the benefit there? Well, the benefit is we have 100 shares of stock that's going up 10 more points higher. And what does that equate to? $1,000, right? All else equal, we're just looking at a 10-point move on a $100 stock. 100 shares on it's a more expensive stock, but if a 10-point move off of 100 shares would be an extra $1,000, and that would be something we could capture if we chose the 260. But let's just say our expectation is the 250. So that's what we're going to do. We're going to go ahead and go with the 250 right now. So there it is, the 250. Let's click on it. I'm going to try to get a little bit more out of this. Let's just give a little bit. I just jumped it up a couple, about a dime. Okay, there's a little bit wider spread in there. It's a little bit more expensive stock on the T-Mobile. Let's go confirm, and let's take a look and see what we've got over here. Confirm and send. Okay, there we go. Boom. Okay, we can look at that again. Sorry. Let's just see what we got. I wanted to look at a few different things, but there's your credit. There's your max loss. You've got break evens. You've got the buying power effect to be mindful of as well in there too. Okay, you know what? Yeah, the break even on the stock price, okay, as I'm seeing this, is around the the 250. So I've kind of flipped that around in my head. Sorry about that. Oh, sorry, let me get my drawing tool in here. That helps. Yeah, let's get that going. There we go. Okay, yeah. so used to looking at it on the short put side here, but let's just talk through that too a little bit. So we are getting a credit here, of a potential credit to receive of $550. That'd be like the max gain, right, that we're seeing right over here. Oh, drew through that. But there you go with it. You've got that credit right there. Okay. Look at it in terms of the call itself. It's a little bit tricky when we're dealing with a covered call. So we've got the stock, and we're not putting this trade in as a full position right now. I mean, this does not contain a call and the stock at the same time, a short call and the stock. So it's looking at it just from the perspective of the short call itself. Does that make sense? Okay. Let's send it through. Oh, we already did send it through. We're done. Okay. Okay, let's continue on. I wanted to go ahead and show you one that I don't own any. We don't own any shares on in our paper money account. That's going to be Abbott Labs. Now, Abbott Labs is a company. Every one of these we've talked about does have dividends associated with it. There's Abbott Labs. This company here, it's a dividend aristocrat. I believe it's a dividend king. I think they paid dividends for over 50 years consecutively. It's been around for a long, long time. And you'll notice over here with Abbott Labs, one other thing we could be looking at too are these longer term resistance points. Put a big R there. Right at resistance. And have we struggled near that level? Well, we kind of have. I mean, there's been a kind of through here, we're getting close again. If a trader was anticipating that the price of the stock might kind of bounce around here or retest that level, but they still think that there could be an expectation for prices to go maybe up a little bit, maybe around that 120, which we've been hitting recently and over here as well. They could buy the stock and sell the call roughly at the same time. Okay. And of course, if we were breaking those up, what we'd always want to do first is buy the stock. You want to have this, you don't want to ever go naked the short call, right? That could be a big issue. So how might we do that? There are a couple of different ways just to show you real quick. If we could jump in, we could buy the stock first, and then we could actually sell the call right after, right? And what would be a gain on something like that? Well, it depends if we were selling the 120 strike, the call, and where we're at right now. I'm going to say approximately, let's just say 118. So if we did 100 shares, we've got $200 we could make in that scenario if the price of the stock does go above 120 by expiration. So 200 on the stock, because we're saying we're approximately 118. Now, what are we getting the call for? We can go over here and take a look at it. Here is our 120 right there. The call gives us $215. So we're generating an additional 215 potential income at expiration. So $415 less any commissions on the transaction itself. But there you go. So it's only, we're actually getting a little bit more than even the price move of the stock, but that could be a potential strategy. What kind of return is that? Percentage-wise, what kind of return would we be getting on that? It's going up, how much? $4.15, right? Let me grab my little calculator here. I'll pull it up on the chart. Let's see. What kind of return could we get on that? Oh, there it is. Price of the stock. We know that at expiration, we'll just use this $4.15. $4.15. We're going to divide that by the price of the stock itself, which is 117. We estimated 118, just as an estimate, okay, as a percentage. So it's about 3.5% we could get on that at expiration, if the price of the stock went above that level. That's not, if you think about that, 3.5%. What is the dividend yield on an annual basis? Just as a broad comparison, dividend yield's 187. So if the expectation was that you thought the price of the stock would go a little bit higher, maybe not too high, but just above that range by whatever, expiration date we're looking at, that's an additional way buying the stock and selling the call in the form of a buy right covered call to generate kind of a return maybe somewhere in that area. We were using those specific numbers, but there we go. Okay. So we've looked at a couple of different ways, a few ways to use covered calls that might not be standard, but hey, with a covered call, you want to look at all aspects of it. Are there ways that we want to try to exit the stock, maybe, and to capture a premium to do so? Well, it has to unfold the way we anticipate, of course, but yeah, I mean, when you're getting called away, that's the selling of the stock. We looked at other ways too, just selling the call over a period of time when the expectation is for the price of the stock to simply hold within a range that you're expecting it to hold into. Another way, on top of what we talked about in this class, on top of dividends hidden in there somewhere, right there in the green, but that could be, and we're just looking at an additional form of adding income to an existing trade you have. Or finally, as we finished off here, the buy right option, or I should say the buy right kind of version of the covered call. You buy the stock and you sell the call roughly at the same time. It doesn't have to be at the same time, but it can be, the same time or very close to it as well. So a couple of different things I wanted to point out there for you too. Yeah, a lot of times, in one of the classes I do teach, which is market and sector analysis, this is the so this, I'm just going to show you over here. This is the playlist for that. We'll talk a lot about markets and sectors in this class. And this class in particular, we do go through and we look at some of those groups of sectors and industries, in many cases, that are going sideways or are positioned to maybe showing some strength in terms of a balance. Maybe the trend is changing, for example. But you can find that as a playlist. I'll just throw this down here if anybody's interested. But that's honestly a lot of times when I'm looking at covered calls or any sort of generating of income through the short puts as well. A lot of times those sectors can be interesting. There are a number of sector ETFs as well, and industry ETFs that can be less volatile, that are optionable as well. You can look at too, and that can be somewhat helpful. All right, folks. Well, hey, it was good to be with you today. I wanted to share these concepts with you, so hopefully they can help you out with potentially existing stocks in your portfolio or just getting used to that in a paper money format. Wanted to say, yeah, if you can, bottom right hand corner of the screen, be sure and subscribe to our channel. And then on top of all that, wanted to just say as well, if you like today's presentation, be sure and smash that like button. Love to have you on board our channel, and look forward to our discussions each and every week. So on that, we'll chat with you next time. Thanks so much, James, for your help with the chat. Good to see y'all. Bye-bye.